Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every week from his homestead located somewhere in it could be the northern or southern hemisphere. We're really not too sure. It varies by the day and whether he's on a milk carton or on a poster in the post office or not. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes, and it is time for Investing with Charles. Charles, I'm going to jump right into it. Over the last several weeks, the market has been bad. I mean, it has been, not good. I don't want to oversell it. But
no, I think bad is actually not selling it hard enough. April was one of the worst months in years, and
it's carried over into July.
Start. Yeah,
and it's carried over into May. It's not, it's not pretty. There's been a lot more downs than there has been ups, and the ups have not compensated for the downs, and it's just a rough place to be. No matter what your investment level is, whether you're an institutional investor, whether you're a retail investor, whatever your portfolio looks like, if you're looking at it on a daily basis on your trading platform, odds are it doesn't look good, and that's understandable. But one thing to keep in mind is that we're here for you, and we want to make sure we provide you with the best information to make sure that you mitigate those losses, and that you look ahead and realize that market downturns are always going to happen, but they're not permanent. So there is upswing potential. Who knows when, but it is going to happen. So that is the one thing we can be solid on. Now, today, what I want to focus on is not necessarily stocks, because that gets a lot of the headlines, especially in a down market. But also what garners some attention is hedges. How you can position your portfolio to kind of start to mitigate those losses that you see in equities, and by using things like bonds, or we've heard a lot about crypto. Crypto has been very big of late in terms of a potential hedge, although the crypto market hasn't really looked much better than the stock market. What I want to focus on today is what was used to be probably the most common hedge against a market downturn, and especially against inflation. And since we're in a time of deep inflation, I believe 8.2% on an annual basis as of last month, as high as 8.5% the month before. And that is gold. Gold has been overlooked a lot of late. It's not, a lot of times when we see these things happen with the market, with inflation, it's gold this, gold that. We're not seeing that now. And I guess I want to start off by asking, why do you think that is? Why are we not hearing enough or a lot about gold as a potential hedge against these downturns that we've seen, not only in the economy, but in the stock market?
Well, no, recently, the reason gold has not gotten a lot of attention as a hedge is because it hasn't been performing super well. And let's return to that a little bit later. Gold's recent declines, I think, are signaling something important. And, I'll tease that because we're going to get to that here in a minute. But kind of the more fundamental question is, why gold? John Maynard Keynes called it a barbarous relic. Warren Buffett's had quite a few jokes about gold. He said, in what world does it make sense to spend just a fortune digging this thing out of the ground only to melt it into little bars and then rebury it in a vault? Does that really make sense? And of course, when you look at it like that, it does seem a bit silly. But the benefit of gold, the reason it even still exists as an asset class is that it does tend to be minimally correlated to other asset classes. And this kind of gets down to kind of the basics of, how do you build a portfolio? I'm primarily the dividend guy, the income guy. That's a really big, important part of what I do. But if you're building a more comprehensive portfolio, you need to be diversified. And having some shares of Microsoft and some shares of Apple, that's not diversification, because those two stocks tend to move fairly close together, right? You need to have different asset classes that really don't move together. And so Ray Dalio, the hedge fund manager, kind of had some thoughts on this. He's like, look, you need to have an all season portfolio. You need to have something that does well when there's inflation. You need to have something that does well when there's deflation. You need to have something that does well under every condition in between. And so that's where gold fits in there. Gold historically has been a pretty good inflation hedge. Now, not every month, every quarter. I mean, there is noise. This is the market, man. There's always noise, right? But there's, over decent sized time horizons here, gold has been a pretty good inflation hedge. So that's kind of why you include it in the portfolio. For example, in the 70s, which was before our time as investors, That was a rough time to be in bonds. It was a rough time to be in stocks, but it was a fantastic time to be in commodities. So if you had a balanced portfolio, you might have been taking some pain in your stocks and bonds, but you were making some money in the commodities that helped smooth it out. So, that's really the key, is just having eggs in different baskets and making sure those baskets aren't all in the same truck that's at risk of crashing.
Now, you talk about the performance of gold, and we'll pull up a chart here that shows how gold has performed on an ounce cost basis over the last 12 months. And as we can see, it reached a high of a little over $2,000 per ounce in March of this year. But then since then, it has dropped around 11.7 to 12%. Just in a very short amount of time, and its price now at just above $1,800 per ounce is actually lower than it was 12 months ago. So it's been much lower. It's been below the 1750 mark, but it's now lower than it was a year ago, and we've seen a pretty significant drop in a little over a month in the price of gold. What does that tell you?
A couple things. So one important caveat here is, okay, I don't subscribe to the view that the market is this all-knowing deity that, the price is right at all times. If that were true, then no one would ever make money in it. Our friend Adam, his technical stuff wouldn't work if that were. It's obviously the market is prone to overshooting either way, right? And so what we've seen in the price of gold is some of that. Gold got a little bit too expensive in 2020, and then it has kind of corrected off and on since then. Now, I think there could be another takeaway from that, though, and that is, for all this talk about inflation, the Fed was kind of insisting here that this is going to be transitory. This is going to be transitory. I think the action in the price of gold suggests that may actually be true. If the market did think that inflation was going to stick around and this was going to be sort of endemic, and we're going to have 1960s, 1970s style, just perpetual inflation that's you can't stamp out, then I don't think you would see the price of gold correcting like this. I think the fact that gold is correcting, and you see to some extent some confirmation of this in the bond market. Bond yields really spiked this year, but they've stopped spiking. They've sort of leveled out for now. So I think what the market is telling us is, and again, the market is not this all-knowing deity, it can be wrong, but I think the market is pricing in that inflation actually will fall in the coming months. I think that's exactly what we're seeing here.
And I think if you're a consumer in the U.S., as we all are, you're really hoping for that, because high gas prices, everything at the grocery store is higher.
I'm a consumer in Peru at the moment.
Well, okay, then what you say doesn't matter. But no, I mean, everyone is feeling the pain of this higher inflation. As the price of everything at the grocery store, anything you buy at a retail store, gas, everything is significantly higher, and it is causing a bit of an economic crunch across the U.S. and globally. This is not something that is just constrained here to the U.S. We're seeing it in Europe. We're seeing it.
Everywhere.
We are seeing it in South America.
Everywhere in the world.
Everywhere.
There's not a single country in the world that doesn't have at least some inflation right now.
Exactly, and some even higher than ours. We aren't the worst. We certainly aren't the best. We're kind of right there in the middle, but it still hurts regardless, of where you're at. So now, if you're thinking about adding gold, or maybe you already have gold in your portfolio in some form or fashion, I guess my first question would be, in what form? Because gold comes in a lot of different forms. You've got we've got bullion, you've got bars, coins, whatever, what have you. There's also ways that you can invest in gold using ETFs, exchange traded funds, things like that. What would be, in your mind, the best way to start to diversify that portfolio and use gold as a potential hedge here?
Yeah, well, it depends on a couple things. It depends on how long you intend to hold it. It depends on kind of what your ideology is, and perhaps tax considerations. So personally, I think it's just fine to own gold via an ETF. Now, I prefer the ETFs that actually own underlying gold bullion, because that's the asset class you want. There are some products that trade in gold futures, and that's okay, but that's a different product, right? there is a timing component there. And that's, if you're wanting just pure exposure to the yellow metal, then getting one of the ETFs that actually holds underlying bullion, that's the best way to do it. Now, some people might argue that, look, if gold is a crisis hedge, if it's a zero hedge, if you will, it's a hedge against everything just blowing up, then you don't really want to have it in the financial system. You'd rather just have some gold coins or some bars, buried in your backyard. I think that's getting a little bit ideological, and that's the way I look at it. If things ever got that bad, then your gold's not going to be worth anything either. The only currency that matters at that point are canned goods and shotgun shells, right? So in the real world that we all have to live in, I'd say the ETF route is fine, particularly now since the cost of holding those ETFs falls by the day. I mean, like, some of these have expense ratios of 14 basis points. It's very, very inexpensive to hold them. And holding actual bullion, there are costs. It's not as liquid of a market as ETFs. So that bid and ask, if you go to a coin store, there is a spread between the bid price and the ask price, and you pay for that. And then beyond that, there are security considerations. If you own a bunch of gold in your house and people know, that you are at risk of theft. So, just owning it in a brokerage account or an IRA or whatever, that's easy. That's really the path of least resistance. Yeah, that's what I do personally.
A bit of a curveball here. What about miners?
So miners, if you want to speculate on gold, if you're thinking of gold as sort of this long-term asset class, just something you have in the portfolio to balance out the stocks and bonds and other assets, then what you want is the metal. Like, that's giving you better diversification. If you are rolling up your sleeves to speculate, if you think the price of gold is going significantly higher, then by all means, play with the miners. If whatever move you make, whatever move gold makes, miners tend to have a more extreme move. So if you're expecting gold to go significantly higher, by all means, try your luck in the miners. And you get one bull market right in miners, you'd never have to work again. That's one of those opportunities where you can easily make 10 times your money if you time it right. I'm losing my earpiece.
Now, what about, regardless of how the direction you go in terms of your gold investment in your portfolio, is there an appropriate size here that you should be looking at to have gold as a percentage of your portfolio?
Yeah, there's different ways to think of that. And my general rule, you could get real specific on it and do a portfolio optimization and really get that ideal amount. But the way I look at it, the markets are messy enough, and the data you deal with, the regimes change. You go from high inflation regimes to low inflation regimes, and trying to overthink it can really you can end up spinning your wheels. To me, I would say keep it simple. Put something like 3 to 5% in gold. If you're really worried about inflation or really worried that this could become systematic, then maybe go as high as 10. But I wouldn't go much higher than that. At some point, you can have too much of a good thing, just like you can be overinsured. If your house is worth whatever, 200,000, and you're insuring it for $500,000, what are you doing? You're just paying a lot of money, that you're just paying more in insurance than you need, right? So the same applies to gold. Whatever your reasons for buying it, just keep in mind you can have too much of a good thing.
So the underlying message here is that, in these market conditions and with inflation, diversification is key. And we're not talking about just diversifying the type of stocks that you have in your portfolio, but diversifying into different asset classes. We mentioned gold. Gold is still viable. Yes, I assume that your gold is still viable at this point, regardless of its price drop of late.
Well, that's just it. If you're following an asset allocation model, and you always want to have something like, again, 3 to 5%, whatever that number is for you, you have your criteria when you rebalance. And if gold, let's just say it drops to where you wanted it to be 5% and it drops to where it's only 2 or 3, well, then you buy more, you rebalance, right? But then on the other side of that is, if you have some gold, it really rips higher and you wanted it to be 5% of your portfolio, but now it's 10, take your profits, sell it back down to your model. That's what you do. You buy low and you sell high constantly. So that's in my view, that's where gold really has long-term value. Shorter term, yeah, just speculate in it, have fun. There's nothing wrong with trading. We do it all the time. It's great. You can make a lot of money, of course. But when you're looking at that long-term portfolio, that's where gold is. And yes, I do consider it viable. I consider it a long-term holding.
Very good. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. If you want to know more about Green Zone Fortunes and how you can get expert opinions from Charles, from Adam, from myself, as well as stock picks that we believe are going to crush the market by at least 3 times over the next 12 to 24 months, plus a lot of in-depth analysis, we'll put up a link up top here to where you can find out more about Green Zone Fortunes. Also, check out moneyandmarkets.com each and every day and look into our stock power rating system. This is where you can get the ratings of thousands of stocks. We rated on 3 technical and 3 fundamental metrics to give it an overall score to let you know whether it is a good buy or one you should maybe avoid. You can go to moneymarkets.com, look in the right-hand corner of the search bar, type in any ticker or company name, and you'll be able to pull out the ranking that we have. It's broken down to those 6 metrics, plus you get a stock chart. You'll be able to see fundamental data in terms of the company's finances and any analysis that we've written on moneymarkets.com related to that company. It is all at your fingertips for free at moneyandmarkets.com. So check that out. Again, he's Charles Sizemore. He is the co-editor of Green Zone Fortunes. I am Matt Clark, research analyst for Money and Markets. Until next time, everyone, safe trading.